All right, hey, how's it going, everyone? My name is Amos, and welcome back to Dividend Compounders with Cheese. This is part one in a three-part series where I'm going to teach you the financial statements. And I'm going to use very simple language and make sure that it's easy to understand, all right? So layman terms, so that way you can understand what the heck a balance sheet is. And you can pull up your favorite financial website that you use to analyze your stocks. If you don't use any, my default is usually Yahoo Finance or stockanalysis.com. And once you pull it up, click on the Financials tab and you're going to see the three financial statements. Today, we're going to be going over the balance sheet. And as you can see as an overview, there's a million different line items, right? And it can be very intimidating. But in this video, I'm going to go over what's relevant and what's important, especially for me as a value investor. Because everything here, yes, it's important, but I think some of these line items are more important than others. So on a high level, what exactly is the balance sheet? It tells you the net worth of a company, the liquidity situation, like how cash heavy are they, and overall risk associated with leverage, aka loans, aka debt. And the cool thing about a balance sheet is there's three parts to it, okay? So as I scroll down, you'll see that says total assets, right? The assets of a company, whatever they own that has economic value. And as I scroll down, the second part of the balance sheet is going to be liabilities. And as the name might imply, the liabilities include all of the monies owed to creditors. And then the third part of the equation is the shareholders' equity. This is money funded by past earnings and through shares outstanding. And that's why sometimes when a company runs into liquidity issues, they raise more capital through issuing more shares and consequently diluting the shareholders. It's something that I don't like to see, but it really depends on the context of the business at hand. Because if it's a REIT, or a BDC, then issuing more shares is the primary way that they raise more capital, and it's nothing to be scared about. Now, the cool thing about the name a balance sheet is the total assets, so you see this number right here, $1.1 billion, it's going to equal total liabilities plus shareholders' equity. So if you add these two numbers up right here, the 500 million right here and 650 million, it'll equal the exact same number as here, 1.1 billion. And if you haven't noticed already, we're doing a working example with Berkshire Hathaway, ticker symbol BRK.B. This is the conglomerate that is associated with Warren Buffett. They have so many different little businesses and companies within their own portfolio, including Brooks running shoes, which is my preferred shoes to wear when I run. They also have Dairy Queen. They also have Geico Insurance, and the list goes on and on. And as you have the balance sheet pulled up, or if you're just following along with whatever you see on your screen right now, this is measured in millions. So I was mistaken. This right here is going to be $1.1 trillion of total assets in their portfolio on their books, which is equal to what? The total liabilities plus the shareholders' equity. This is also known as the owner's equity. And before we get into all of the little details, it's really important to understand the balance sheet because the three financial statements are connected to one another, and the balance sheet itself tells you the overall financial health of the company, the current net worth of whatever business it is that you are examining, the income statement, the balance sheet, and the cash flow statement. So with that said, let's look at the first part of the balance sheet, the assets. So as you see on your screen on the left side, everything right here, this is going to be the cash and cash equivalents. So whenever I say that, this is what I'm referring to. It's basically all the cash that they have in their checking account, in their wallet, or in treasury notes and bills, or in a money market fund. Short-term investments is anything that they can liquidate and transform into cash at a moment's notice. So they have $347 billion of cash on hand. And in the category of assets, that's the first really important line item, the cash and cash equivalents. The next thing is going to be the accounts receivable. This is basically how much money people owe you. So pending payments. So in other words, you already gave your product or service to the other person, and now they owe you the money. You sent them the bill, the receipt, and it's on them to pay you on time to whatever the agreed upon timeline is. The next thing that I like to look at is the inventory. As the name might imply, it's the valuation of all of their merchandise or products or t-shirts or cars that they may have in their warehouses and in the stores. And in the case of Berkshire Hathaway, we're talking about $27 billion of inventory. And the pretty cool thing about a balance sheet is everything is systematic and it adds up. So if you take all of their cash and cash equivalents on hand and you think about their inventory and their other current assets, it adds up to this right here, this row. So as crazy as it might sound, Berkshire Hathaway has $427 billion of total current assets. Everything right here added up is right there. Now the next thing that we're going to be taking a look at is the PPE. This is the property, plant, and equipment. So this is everything including like the company laptop that you get issued when you get onboarded to a company, the office chairs that you sit in for the company meetings, all of the forklifts in the warehouses, delivery trucks, machines in their production plants, data servers, the list goes on and on. If it's an equipment or something that you utilize to do your business or service, it goes into this row right here. And what's interesting about the PPE is whenever a company spends money in order to build out their property, plant, and equipment. Case in point, a really recent example is going to be like Microsoft or Google. They're doing CapEx. So when they do capital expenditure, they're building out something that's going to serve and help out their business. Okay, so CapEx is kind of like an asset building number in which some people believe that all CapEx is terrible and is evil. But if you understand that CapEx is for the long-term health and growth of a company, then you understand that CapEx is not that evil at the end of the day. So even though Google and Microsoft and Amazon, I think they're spending billions of dollars right now building out their data servers, which are going to be placed right here into the PPE, it's a temporary setback, right? They're spending that money, but in the long term, that's going to increase and improve their bandwidth in order to meet more customers as they use their cloud services. So once you understand the accounting principles that are associated with the balance sheet, you start to realize that it's not that bad in reference to the CapEx. And before we go any further, the reason why we're looking at Berkshire Hathaway is not too long ago, I sold completely out of my position in Microsoft and Nvidia. So what I'm doing right now is I'm holding on to this capital, this cash, and I'm kind of monitoring and I'm eyeballing a few companies. And believe it or not, Berkshire Hathaway is one of those companies. Because as we take a look at their overview, right, this is a company that usually trades for a premium because it's well run, the management team is super good. When you think about their fundamentals and metrics, above average in nearly every single category. And the reason why I'm eyeballing them is right now they're going on a sell-off, right? From their highs of about 540, they're down to 480. So what I'm thinking is, if the volatility in the stock market continues and inflation news keeps coming out and the overall sentiment in the stock market is fear and uncertainty, I feel like they could drop further. So if they reach a price point of about like 450 to maybe 420, I think that's when my left eyebrow is going to be raised. And if they hit about $400 a share, that's probably when I'm going to start dollar cost averaging into this company, contingent upon their balance sheet looking good. So using them as a working example, let's get back to the video. We just went over their PPE, and now we're going to be talking about their goodwill. Now, the best way that I can describe it is, think of goodwill like a seller's market for houses. You know, when people get desperate, when you move to a new area like Nashville or, I don't know, Austin, Texas, there's going to be a lot more buyers than there are sellers that have the availability of homes for sale. As a result, the buyers usually pay above their market value price of the home. So say they're selling a house for like 300 or maybe 350 grand. Because it's a seller's market, you're going to have people, 5, 6, 7, 10 families telling the realtor that you are willing to go 40, 50, 60 grand above the market price. So if the family that is selling a house is expecting like $300 out the door, $300,000, then someone else will come in and be like, hey, I'll pay you $360 right now, all in cash. So goodwill is whatever premium that Berkshire Hathaway pays above the fair price to buy out another company. So whatever that valuation is, it's going to get put into this row right here. So that hypothetical $60,000 would be placed here. And you might be asking yourself, well, why the heck in the world would any company want to pay above the fair market price for an acquisition? Well, that's a really good question. Usually, companies pay extra for an acquisition if the company in question has a growth story that makes a lot of sense and will bring future economic benefits to Berkshire Hathaway. Such as, for example, when Facebook paid $1 billion for Instagram back in 2012, because Instagram was a social media that was taking everybody by storm. It wasn't just here in the US. The Europeans, the Asians, dude, everybody loved Instagram. To be sold for only $1 billion in hindsight? Dude, highway robbery. However, let me clarify and fix myself. At the time, I think Instagram was only valued at like $600 million or something like that. So Facebook overpaid by like $400 million to bridge the gap to bring it up to $1 billion so that Instagram would sell all of their rights, intellectual property, user data, and whatever else they had to Facebook. So to answer the question in goodwill, why would a company overpay to buy out or acquire another company? Think about it like this, okay? Instagram in 2024, do you know how much revenue they generated? $70 billion. And remember, Facebook paid in cash $1 billion to buy out Instagram in 2012. That's why companies pay more than market value price if they know the company that they're buying is going to grow their top line at a more aggressive rate. So that's goodwill. And the last line item I think is important for assets is the other intangible assets. This is everything and anything to do with patents, trademarks, copyrighted information, proprietary technology, the list goes on and on. An example, Disney and Mickey Mouse. Whenever somebody around the world has a bright idea to make a product or a t-shirt or a sofa that has Mickey Mouse on there, well, guess what? Disney is going to get a royalty fee and a royalty check. So having intangible assets a part of your portfolio is, in my opinion, a huge economic moat. And that's why when I evaluated Disney in a very recent video, I said Disney has a crap ton of potential, because if you open up their vault and think about all of the different Disney stars, princesses, and characters that they have trademarks and patents on, I feel like the combination of shows, merchandise, it just sells itself. Everything added up is the total assets. And now we're going to go ahead and talk about the liabilities, the monies owed to creditors. And to be honest with you, I feel like the only really important one that we have to discuss is accounts payable. So it's the money you owe, such as to the manufacturing hubs, to the suppliers, to the third-party truck driving company that's moving your stuff on behalf of your company, but is not actually part of your payroll. Any money that your company owes for goods or services that you received, but you have not paid for yet. And I would argue another important line item in the liability section is the short-term debt. It's an aggregate of all of the loans on their books that are due within 12 months. By the way, if it says current, it's anything within 12 months. So as we scroll up right here, total current assets, anything that can turn into cash or has the ability to transform into cash, current assets within 12 months. So scrolling back down to the total liabilities, the next one is the short-term debt. Now, regardless of the industry or sector, you do not want to see this number be a lot higher than the cash and cash equivalents. Because think about it. If you have like $20 billion of debt that's due in the next 6 to 12 months, but you only have like $3 billion of cash on hand, yeah, you're going to be in a pickle. Okay? I'm not a gambling man, but I would argue they're going to be in a really tough situation to climb out of. So everything right here adds up to the total current liabilities, all the money that Berkshire Hathaway owes in the next 12 months. And I guess another really important line item would probably be the long-term debt. This is all of the different loans and debt that's owed past 12 months. So the contractual obligations will be like 5, 10, 15 years out. They have a lot. $124 billion of debt in the long term. That's pretty wild. When you add up the short term and the long term together, their total liabilities is $507 billion. And now the next section of the balance sheet is going to be the shareholders' equity, or also known as the owner's equity. It's the money put into the business by the owners of a company. And believe it or not, the shareholders, you and I, if we have shares of Berkshire Hathaway, we are the true owners of the company. No, we're not the CEO. No, we're not the CFO. They're the ones that are operating the company, but the shareholders are the owners of the company. Because when you buy stock of a company, you're putting your capital into the business. Okay? I don't know if you knew that or not. And in the case and purpose for a value investor looking at a balance sheet, I think the only important line item in the owner's equity section is the retained earnings. It's the accumulation of all the prior profits or losses. Usually, businesses will use this money on the books to fund the dividends from an accounting perspective, okay? Or they do share buybacks. It's the money the business owes the shareholders. Because when you buy into a stock, you're not doing it for charity or to just donate that money, unless you're buying into speculative growth stocks that never turn a profit. Then, of course, you're just handing your money over to them. For the most part, if you are a value investor, you're buying into a company because you expect a dividend, right? Or for your portfolio to grow at a rate of 8 to 20% year over year. Retained earnings are the monies that are owed to the shareholders. So now that we understand all the tiny little details of a balance sheet in the perspective of an investor, not as an accountant, because if we want to look at and examine a balance sheet from the eyes of an accountant, dude, we would have to dive even deeper. However, you can consider this as walking around in the kiddie pool with urine everywhere. Yes. All that to say, as an investor of stocks, there's 2.5 metrics that I look at when it comes to the balance sheet for any company that I am potentially assessing or evaluating, like, do I want to buy them or not? And the first one is going to be the cash situation. Okay, we already did this with the Chagi example about a few days ago, but we're going to do it again with Berkshire Hathaway. So what I mean by that is when you think about the cash that a company has on hand in their wallets or in their checking account, what do you think you want to see? A trend where it's decreasing year over year, a trend where it's growing, or for it to be stabilized? So I think best case scenario, you do want to see the amount of cash that they have be growing in a positive trend. But I think the next best thing is for their cash to be stabilized. Like if Berkshire Hathaway can pump out $347 billion of cash on hand for the next year, next 2 years, next 3 years, I don't think that's a bad thing. However, what we are seeing is that in fiscal year of 2020, they had $138 billion of cash and cash equivalents on hand. And in the span of 5 years, that 138, now they have $347 billion of cash and cash equivalents on hand. And just year over year, going from 2023 to 2024, it increased by 99%. So the first metric, the balance sheet, the cash situation, I would argue this is phenomenal. Like, this is bonkers. This is really freaking good. Between you and me, I expect nothing less from a company that is associated with Warren Buffett. And in case I forgot to mention, you do want to see a company be flush with cash because it gives them a margin of safety in case anything arises or any sudden setbacks happening. They have the cash to deal with it, and it gives them some financial flexibility. If they see a threat, if they see competition growing from a startup, they can just buy them out. So having cash on hand is a good thing, okay? The next metric is going to be the cash to debt situation. And the cool thing about most websites is that that metric is already automated and it's already on the screen for us. So as we scroll down, we can see right below the owner's equity is going to be the total debt. And from that number, you're going to subtract it from the cash and cash equivalents on hand, which spits out the net cash position. Now, in a perfect world, you do want to see this number be positive, meaning they have enough cash on hand to pay off all of their loans, all of the debts on their books. So in the case and example, Berkshire Hathaway, they have about $1.9 billion of short-term debt, and long-term debt is $124 billion. You add it all up, their total debt is $125 billion, but with the amount of cash that they have on hand, it's surprisingly not too high, because after paying off all of their debt, they still have $221 billion of cash on hand. And the crazy thing is, for the past 2 years, it's been a very positive cash situation. The only yellow flag would be fiscal year of 2022, because after paying for all of their debt, they only had, I say only, $902 million of cash on hand. But I'm willing to bet that Berkshire Hathaway back in 2022, they had to use and tap into their cash reserves in order to do legal fees or buy out another company or whatever it is. And that's why I'm telling you the cash and cash equivalents is so freaking important. The last metric that I like to consider is that their debt is manageable. Because if you just see this number that says $125 billion of debt on hand, you don't know in the context of Berkshire Hathaway, is that manageable or is that even small? All that to say, there's many different calculations and ratios to pick and choose from in order to evaluate and assess whether or not a company's debt levels are manageable. For me, I like the debt to EBITDA ratio, because it takes the total debt that they have on their books, and then we take a look at their EBITDA, which is their operating profits, and from that, we can figure out how long would it take from just their operating profits to pay off their loans on their books. Because worst comes to worst, the $125 billion of debt that they have right here, you don't really want to be tapping into this in order to pay that off if something were to happen and they have to pay all of their debt right now. Instead, I think it's more proper and a more strategic choice to use the money that's flowing into the company right now in order to pay off the debt instead of opening up the vault. Does that make sense? So what we're going to do right now, we're going to plug in $125 billion into this calculator, and we're going to divide it by the EBITDA. And to do that, we need to jump over to the P&L statement, also known as the income statement. Scroll down to find the EBITDA. It's 116. So let's see. So we're dividing that by 116,437. So $116 billion. So it would take them 1 year to pay off all of their loans, all of their debt from just their EBITDA. So I would argue their debt is absolutely manageable, because the golden standard is to see a debt to EBITDA ratio of 3 or less, depending on the industry. But Berkshire Hathaway, I think they fall under the 3 or less rule. And to have a 1, dude, that's absolutely beautiful. So my takeaway from this is Berkshire Hathaway's balance sheet, flush in cash, their debt levels are manageable, and their numbers look really amazing. I would argue this is probably an S plus balance sheet, maybe even like a A plus, S minus, regardless, above average, and it's really pretty. So next time, we're going to be talking about the income statement. This one right here. This is the P&L, the profit and loss. Me personally, I'm more of a fan of the income statement because it shows you the numbers that a company is generating right now with a future focus. Whereas the balance sheet is referring to the past, like what happened already. And I guess the analogy that I can paint is, if you think about the income statement, I'm a fan of Tottenham Hotspurs, okay? So if they have one match in the Premier League, so let's say it's a North London derby, it shows their performance now. Let's go ahead and assume that we beat Arsenal 3-1. That's what happens right now, and that's our performance and how we're doing. So how much revenue we're generating right now. Whereas when we think about the balance sheet, it's the season's entire stats. So for Tottenham, we finished number 17 out of 20 teams on the Premier League table. It's an accumulation of all their games, wins and losses. What was their overall performance in a season? Does that make sense? So the income statement is their performance in a single game, and the balance sheet is their entire season wrapped up. So if you like the way that I explain things, we're going to be going over the profit and loss statement next time. Let me know what you think of this series, and if you learned a thing or two, let me know in the comments section. Other than that, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. See you guys.